2018 to 2020, we literally had run out of money. Like, I had stopped taking salary for 6 months.
From 2020, WeWork has had a comeback that should be written down in history books. Last year, it made a revenue of 1800 crores, and we sat with the man behind WeWork India itself to understand its massive growth. In this episode, we dive deep into how Karan built his workspace rocket ship, covering 3 core insights. Number 1, what is the WeWork model? Second, how WeWork generates revenue. And finally, the commercial real estate marketplace of India.
2018 to 2020, basically, those 2 years were very difficult. We actually had no money at all, while we had signed almost 20 locations and we were actively building these locations out, and we literally had run out of money. Like, I had stopped taking salary for 6 months. We had delayed some of that so that other employees could get it. We were trying to raise money. It was in the midst of this NBFC crisis that happened in India, so liquidity had dried up. And soon after that, WeWork tried to go public, and there was a lot of backlash from press, and then COVID also came through. So there was one phone call when I was trying to raise money, and then finally WeWork Global themselves said that they'll put in the money. And we had worked 6 months on getting that transaction done. I had committed to my vendors, and then suddenly this management change happened, and then I got a phone call saying, look, we can't do it. And I remember being in my balcony in my room, and it was probably 8:39 in the night, and I just had this huge sinking feeling in my in my stomach.
We'll come down to about 2015, 2016 is when you were tinkering, I think, with WeWork.
Yeah.
Tell me, what were you seeing then? Tell me, when did you even discover it?
What happened was that WeWork actually didn't want to come to India. They were just starting their global expansion, and they were looking at China because China was just such a bigger opportunity with more money to be made. And that's when we actually told them that, look, we really believe that this is going to work. And so we will put our own money behind it. We will take a franchise license of the brand. You give us everything, like a playbook, and give us the technology, but everything else we'll take the cost of. We'll hire the team. We'll build the business. And that's how the partnership, the first ever franchise or license deal for WeWork, also came about.
Hi Mighty Fam, we have a huge announcement. Over the course of this year, we have been working on something that will not only help you solve your toughest problems at work, but also help you change your career orbits. We are launching 8 new learning modules, which we call crafts at GrowthX. Each craft is designed with frameworks that will not only help you solve growth problems at work, but also drive specific business impacts. The link to check out these 8 new crafts is in the description. Awesome. Let's get back to Karan's story.
A lot of people wanted to understand, how does the model work with WeWork? What is the business? What does it look like?
I think you want to compare it similar to other asset classes within real estate, maybe retail, or to a hotel type of model. It's most closely linked, I would say, to those 2 types of things, where you have an asset and we end up, taking an asset, essentially renting in wholesale and selling in retail. I think that's a very simple way to break it down, where we take a space that's a shell at a cost that we know that we can, by adding our layers to it, we can still resell it, and there is a market or a demand for that type of price. We design it, break it up into smaller offices, and essentially lease it out like a retail operator would lease out to stores. We end up leasing it out to companies that are really growing. So that's what we end up doing, and it's essentially leasing in hyper speed, because our contract terms are much shorter than traditional office space leasing. We have to have a machine that is constantly filling, refilling, and churning it out. So just by taking in wholesale, breaking it up, selling in retail, you end up creating some profit in that entire piece. That's where I would say today 70% of our revenue comes from. Now, when I actually fill it up with people and we have these occupancy sort of like business lines that also then start trickling in: parking, F&B, paying for dedicated internet. Someone wants to use the office more than the hours that we operate. You get overtime, HVAC, like conference room packages, conference room booking. So you're able to build almost like 8 to 10% on top of just the fee that you're charging for the desk, right? Which comes from people just being in the space and using the space and buying other services and things like that. And then finally, over COVID, we launched our digital product stack, where again, like similar to any other asset class, what we try to do is see how we can monetize this to the maximum. We have these common areas in our space where people are more fluid through it. So we ended up creating subscription-based products that allowed you to use those spaces either for a day or for a month, where you don't have a dedicated office and things like that. That allowed us to monetize over like multiples on the space, similar to like a gym where you can sell 100 memberships, but only maybe 30 people will really come and use it, but you're monetizing off of 100. That allowed us to create a bigger kicker, in the profitability of a building. So typically a building will make between like 30 to 40% margins when you stack everything at maybe an occupancy of like 80 to 85%.
Cracking preference in this category is very interesting, especially when you have like a higher price point. People prefer WeWork over other players. As of today, what are the biggest moats that you see that you've built?
I'll start with company culture. That is really a lot of where the secret lies. Scale and access to capital, I think, is another huge moat. So by being the leader, by having the brand, by having a big, the big pedigree and the foundation of Embassy behind it, allowed us to access capital faster, a lot easier. And then I would say has been our turnaround from COVID. Intense focus on turning the business around to creating this margin of safety that we have now that allows us to take better, bigger risks.
So tell me if I'm wrong, because during our research, we essentially figured out there are 2 ways that you make revenue.
So I would say there's four ways.
Yeah, let's talk about that.
One is just a plain lease. So we were just signing like a 9-10 year lease. We then end up investing in the fit outs. We're just a tenant like anyone else. Then there is what we would call like a fitted out deal or like a capex funded deal, where the landlord actually invests in the fit out. It's again like a long-term lease where you end up paying for the rent of the space, and then you also pay like a amortized or rented amount for the fit out invested, and so no money out of our pocket, paid over time with the landlord. The third would be a revenue share split, where we usually say we are bringing our expertise, design, the sales engine, marketing, the OpEx spend will be allocated to the asset, and you are bringing the asset and investing in the capex. Then we have a revenue split, and there is more sharing of risk with the landlord when occupancy of the building is ramping up, typically, which is like the first 6-8 months. You might get lower than what you were getting in a straight lease, but as soon as occupancies cross, let's say like a 70%, we both are making money, and you're making more than what you would get in a traditional lease sort of setting. And then the last is an operator deal, where risk and reward is fully pretty much with the landlord, and it is typically in a location where we feel it is very risky and maybe doing it more for the landlord, and want to keep ourselves a little bit risk averse. That's where the landlord ends up taking all of the revenue. Pretty much we take a small share off of it, which is a hotel operator model. The first two are how we started, and I would say still majorly how we do a lot of our deals. The last two are what we're pushing for a lot more and actually seeing a lot of good reception from the landlords.
I think zooming out, I wanted to get into the market bit, understanding where WeWork stands. One thing that I wanted to understand is the real estate space with the new onset of co-working companies coming in. What is your outlook at it? For example, how are you seeing it evolve in terms of a commercial real estate market space?
Today, India has about 800 to 850 million square foot of grade A office space. And what I call as grade A is a building maybe like this. It's growing at about 50 million square foot a year. And 80 or 90% of all demand resides in those grade A locations in these top 7 cities. For 7 years when we started, Flex was like pretty much zero, of that entire 800 million square foot. Today, we are about, let's say, like 10 to 12% of that market of organized versus unorganized. But if you look at just the organized players, which I will say are pan-India players, have more than, 10 or 15 locations and have maybe over 2 million square foot of space in those operators, we probably have about like a 30 to 35%, sort of like market share.
What's next? So of course, you're here, like thousands of crores of revenue, and like you said, like the opportunity is massive. But what next?
If we've been able to get to this scale in 7 years, I'm really, really excited for what the compounding will do in the years to come. So one, I'm just excited to have and build a machine and constantly keep iterating on perfecting the product and, making sure that this can just keep going. And I'm okay with like no major events happening in the year because we tend to always have some like real supersonic event. So I'm just sometimes like right now just excited about cruising at a pace and, like just building on top of it.